quarter of nine? Well, we will be still reviewing the CPI data, but probably taking the entirety of the week together, which is we've got retail sales, we've got a jobs number coming through, we've got inflation, and yet behind the scenes, the problem is a lot of our data is still distorted coming off of the shutdown. We've got seasonality issues, which we always do in the first quarter, and then we have a lot of known unknowns, like where is tariff policy going to settle? We still don't know the answer to that. And we're wrestling out with all of these data points. What is a cyclical trend versus what is a structural? That's never been more important in my career.
Smart people in Atlanta have the Atlanta GDP now, which is now. It's coming down. Is that a vector in place? And are we going to get real GDP under 3%?
Well, we're probably going to get something for the fourth quarter around 3%, maybe a little bit of upside about that. But again, what is the composition of that growth? We're seeing growth that is great for markets, but not great for the people. We're seeing growth that is really biased towards CapEx, AI, data centers. Now, that's not necessarily bad. It's just a different type of growth. It's not a tide that lifts all ships, and it's not one that's going to create a significant amount of job growth associated with it. It's not growth that's going to save the affordability issues facing consumers. In fact, it's not growth that's going to solve the K-shaped elements of this economy. So it's growth, and that's good, and I'll never knock a great GDP number, but what's happening under the surface is going to be far more important for companies operating in the United States and ultimately for markets too.
I like in your notes, you say we are about to hit the 5-year anniversary of inflation running above 2%. I didn't think about it in that terms. A, the Fed can't be happy about that, but B, who cares about 2%? I mean, where did that number come from? And should we really care? It feels like inflation, it's higher than maybe we'd like it, but isn't it just kind of where we are in this economy?
Well, I guess that's a great way to put it. That's kind of where we are. Where does it come from? Central bank research, predominantly, I think, originating out of New Zealand. The 2% was a great place to be. And I remember even a few years ago, folks would say things like, oh, well, what if we end up with 3% being the new 2%? And this was a really scary type of development. But when I think about 3%, I think that, well, people got worried about inflation surging like it did during the post-pandemic period, 9, 10% as being the real big problem. But here we are actually sort of embedding higher inflation expectations going forward. And the issue is, based on our outlook, we're going to stay in the high 2s and around 3% through the end of this year. So it wouldn't surprise me if you had me back a year from now that we're celebrating the 6-year anniversary of inflation above the 2% target.
All right, let's go to the other side of the Fed's mandate, the labor market. We'll get some labor data this week as well, and the unemployment rate, I think the forecast is for 4.4%. Again, that feels kind of full employment-ish, although you tell that to a recent college grad, and they probably wouldn't feel that way. So how do you feel about the labor market?
Full employment-ish, I'd say that's downright full employment right there. There's only 2 periods in history when we've had unemployment rates that were this low. We actually have a 4.3 in our forecast for this week, but 4.3, 4.4, we're sort of splitting hairs here. So what's happening? Well, we are going to have far less job creation. You're not going to see new jobs being posted. So non-farm payrolls, those are going to continue to decline. We have about 65,000 for this week coming through. Could be lower, and it will trend lower through 2026. But that unemployment rate is not going to rise meaningfully. Why? Because there are not enough people who need new jobs. Coming forward, we only need to create about 40,000 jobs per month or less in order to keep those who want jobs with jobs coming through this year. That's going to take a lot of re-education for markets to really understand.
With the Royal Bank of Canada, Francis Donald with us to get us started. Joining Terry Weissman on deck. In the next hour, Andrew Sliman from Morgan Stanley, Ian Bremmer in the 9 o'clock, with Jean Bovin, BlackRock. Just a fabulous set of conversations today to launch into February and March. I'm going to digress here now for 30 seconds. I think it's very important. One of the great moments for your Canada was to see the Quebec Nordiques on the ice with the Montreal Canadiens here. Of course, the Colorado Avalanche play. Really emotional, actually, folks, to see these two teams. Pitchers and catchers right now, do we need to see Montreal Expos next year at pitchers and catchers?
Sure, let's go for it. I have to tell you, just over this weekend, my husband and I were having a conversation that everyone wanted gold, everyone wants critical minerals, everyone was running after silver, whereas up in Quebec, we're always running after Nordique swag. We just want Nordique hats and sweaters, and if we could monetize that, we could actually beat this market.
When you were a kid, did you see the Expos? Do you have any memories?
Of course we saw the Expos. We saw Yuppie, who was the mascot. It's still embedded in my Montrealer blood.
It's like up there. It's like embedded in it.
It's like hockey Expos, boots in, skiing on the mountain, and being cold. Yeah.
Back on track here with economics, finance, investment with Francis Donald. I look at the makeup here, and the number one thing I get from our listeners and viewers, you guys are idiots. The unemployment rate isn't 4%. We had somebody a couple days ago say the unemployment rate calculated around hiring, a dearth of hiring, is 8%ish. What does our unemployment rate feel like right now?
Well, it depends who you are. I mean, Paul, you highlighted young folks right now. We've seen a huge surge in what we call youth unemployment, those under the age of 25. That's not just an American phenomenon, by the way. That's happening globally. Maybe some AI issues in there. Maybe some hesitancy around how much will tariffs actually burn us. Should we be bringing on new labor here? But we have another theory as well, which is we talk a lot about this no hire, no fire environment, which is so atypical. But there is a shadow hiring market that's happening in the background, which is that if you retire, and we know there's mass retirements, about 2 million folks in America are retiring every single year right now. That's 60,000 folks more per month than before 2 years ago, a delta of 60,000, and you bring in a young person to replace that role, it will not count as new job creation. It will not come up in non-farm payrolls. It will actually just be a replacement hire. So we know that there's hiring happening that's a little bit more in the shadows than where we see. And Tom, I'll tell you again, like if you are in trade or manufacturing right now, your unemployment rate is higher. If you're in healthcare, the job market is extraordinarily tight. So my friend and colleague, Amy Wu Silverman, I think here yesterday, friend of your show, she has this metaphor of a duck that is calm on the water with the feet paddling underneath.
You're going to redux this today.
Oh, I'm going to redux it because it's a brilliant way that she describes it. It's also how the economy is operating with that unemployment rate stable on the surface, but extraordinary churn and transition happening underneath the surface. So it makes sense that Americans feel like they're not well represented in the number, A, because the number's not telling us the whole story, but also because there's this huge fragmentation underneath.
Retail sales, we're going to get 8:30 this morning. How's the consumer doing out there, do you think?
The consumer is muddling through. They've got real wage growth around 1%. That's enough. They have jobs going forward. So you'll be okay on retail sales. But again, incredible fragmentation underneath the surface. High income consumers holding up a lot of the rest, but not entirely. And I think this is the challenge, is that we're looking for a lot of cyclicality in that consumer that's going to be reduced, because if you want a job in America, you probably have one on average. Again, we talked about some other areas. So for a very long time, economists would say the best way to measure the growth of the U.S. economy is to say, if a consumer is employed, then all is right with the world. The consumer is 2/3. But that is no longer going to be the way that we measure the strength of the American economy or the way we measure the strength of the consumer. It's going to be, what type of job do they have? Is it enough to offset the cost of living? Again, 5-year anniversary of inflation above 2%. And what sectors are actually seeing some of that strength moving forward? So I'm looking for more information on that today.
From the Canadian perspective, where are we on tariffs here? Because I don't think we've heard a lot about them recently. I mean, we had the Greenland thing a while ago, but from your perspective, the Canadian perspective, what is the tariff situation?
Well, it depends what country you're speaking from. And actually, trade policy is still very much in flux, right? We have the IEPA Supreme Court decision that may come through. We have USMCA. Mexico, Canada, and the United States are up for review of this very important trade document. And of course, every day we see new information about trade deals that the U.S. is embarking on. So our view is that actually American companies are not sure where tariffs will land. Will they get reduced? And that's really implicating or slowing some decision making.
You've been brilliant on this. And the answer is we were at 2 to 3% blended tariffs. We did a jawboned moonshot out of the Rose Garden up to some ginormous William McKinley Gilded Age number. And there's a beautiful chart in the FT, I think Toby Nangle had it, coming back down, and we're at 10-ish right now.
Yeah.
For you, what would be the number to come back to where you'd say we'll survive? Do we need to get back to 2 to 3%?
Well, I think the issue with tariffs is we always think about them in absolute, as if it's the only shock happening to the U.S. economy. And so I hear all the time, well, look, tariffs didn't impact the U.S. Inflation is, high 2s, about 3%. The unemployment rate is fairly well contained. Where was the big, hoopla that economists warmed towards? Well, number one, I still think it's early. So companies, we believe, held on to market share over the holidays, and you're going to actually see tariffs rise into CPI data into the second quarter of this year. So it's too early to say we didn't see it. But secondly, we have seen this impact. We've seen it in rising goods. We've seen it in layoffs in manufacturing and trade exposed sectors. And I think the better way to think about this is if we hadn't had tariffs come through, you would probably see higher growth, you would see lower unemployment, and you would see less inflation. So you have to compare it to what would the world look like without tariffs, not why didn't the economy break as a result.